As Larry Shover, Chief Investment Officer at SFG Alternatives in Chicago. Larry, great to have you with us. Of course, we have seen oil, as we just mentioned, regaining ground. A couple of analysts that we've been speaking to over the last few days have been flagging energy as being a possible value play coming through. Would you agree?
No, I don't think it's going to be a value play. In fact, the opposite. I'm not a end of the world scenario by any stretch of the imagination. I've just been saying for months that so many bullish things have been coming together at the right time, at the same time, to keep the price up. You know, we just say world growth GDP at 4%. We have supply concerns with geopolitical events, etc. We have good product demand. I'm not dismissing any of that whatsoever, and I'm not dismissing the fact you have OPEC with incentives, keeping the price up. This is all great stuff. However, when you look at like the futures curve, the forward curves, you're seeing some sideways action. To me, that's like a tipping point. I'm also thinking we're going into the peak of refinery season with inventories rising. I'm seeing 1.5 million barrels per day, even during the peak of refining season, and loading is being up as well. So all that to say, I do believe oil is going to be in a very volatile range, but it's going to be a tight range, and I do still think that it's going to be lower by the end of the year than higher.
Just while we're talking commodities, also wanted to get your take on what we're seeing in gold. Of course, the precious metal having that safe haven asset status. We have, in fact, seen gold prices tumbling as we saw renewed confidence once again in equities. And this is really part of this seesaw trade that we're seeing when it comes to gold, that balance between investor sentiment and what we're seeing price-wise.
Yeah, that's a great point, Natalie. And I do think that we all, including me, underestimate the power of investor sentiment when it comes to the gold price, because so much of what we talk about is interest rates, the dollar strength, dollar weakness influencing. And I don't think that's really it. I mean, honestly, when you look at how the dollar fell off the map towards the end of 2017 and the fact that yields really haven't gone up that much, you'd think gold should be at $1,400 an ounce in U.S. terms, and it's clearly not. So there's more to the story than that. At the end of the day, though, I do think gold, beyond being a risk management haven for some people, I do think it's more of a consensus trade on how people believe central banks are operating. Right now, that seems to be, you know, kind of complacent, keeping gold in a pretty tight range, and I think that's what we're going to see going forward.
Now, if we consider some of the broader market action that we're seeing, Larry, it's really all about the techs this week. And I'm actually not meaning, your Amazons and your Facebooks in this instance. I'm talking about the technical levels that we have seen investors moving through. Of course, yesterday we saw the S&P 500 closing below that 200-day moving average for the first time since June 2016. Still some concerns that we could see those U.S. indexes breaking below those support lines. To your mind, in terms of what you're seeing in those technical levels, what is your outlook at present?
Well, you know, my outlook is such that I've spoken for probably a year about how wide the chasm is between value and growth. And so when anything happens at all to the growth sector, to Amazon, Google, Facebook, et cetera, you know, it's just going to have a profound effect on the market. But the truth is, I think on the tech space, I think the market still is fairly complacent about it all. It is true that sentiment is fragile, but on the other hand, I think people just think that every dip in Amazon is a buying opportunity, not realizing that 6 months ago the stock was trading under $1,000 a share in U.S. terms. So personally, I think the tech sector is going to lead the market one way or the other going forward in the short term, and I do believe that there's got to be more deterioration in that space, which in turn will become like a near-term positive and a buying opportunity, but I think it's too early.
Just in terms of your broader portfolio positioning, Larry, we've had a lot of people talking about, really raising their cash levels at the moment when we are in these periods of I was going to say volatility, but we are seeing these wild swings in terms of volatility levels and what that's doing to investor psychology at the moment. In terms of your cash positioning versus your equity holding, how are you balancing that right now?
Yeah, that has not changed probably in 6 weeks. I mean, I'm still overweight Eurozone, overweight Japan. The only change I've made, and that was like 3 weeks ago, I went neutral in emerging markets, and I think it's become too much of a consensus trade, especially China. I'd rather see somebody else make the last 10 or 20% in that trade. But within Japan and within the Eurozone, I still think the top two sectors are financials and industrials. The U.S., I've been neutral, and I continue to be so, except for the financials, because I do believe the yield curve will continue to flatten, but the front end of the curve will go higher. Higher yields will translate into good profits for financials, especially the local banks and insurance companies.
And are you viewing, of course, we're going to get the bulk of Q1 earnings start to really roll in next week, some of those heavy hitter names. Now, are you seeing this as a risk event, or are you seeing this as a good news push?
No, interesting point, because honestly, other than the tech wreck that we've just witnessed, fundamentals really have not changed that much. Let's face it. I mean, growth definitely has peaked a little bit. It hasn't, downshifted, but it's still good. Q1 earnings, it's going to be a really good earnings season. I think the run rate's going to be higher than what we saw in the fourth quarter of last year. Central banks are still early stages. Liquidity is there, still pumping $100 to $150 billion a month into the system. And from a valuation standpoint, there's still a wide gap between the equity market and the government bond market. So I do think it's a good case for the stock market. Like, in other words, the risk, to me, like the value proposition has not changed into a diversified portfolio.
Okay, Larry Shover, unfortunately we are out of time. Great to have you with us though this morning. Thank you.
Thank you.